Ryan says, what do you think about in-the-money calls for risk-defined long positions? Um, I it's a good play. I know a lot of investors do it. Hey, I'm not buying Netflix with my account. I'm not buying, I always said Priceline again, booking.com, Ryan, with my account. Way too darn expensive. I'm not really buying Tesla, honestly, right now, doing covered calls or married puts on those positions. They're too expensive. Have stocks that are too expensive that I like? Yes. I'm likely going to be buying a call option on them. I can't do a married put, which I would normally like to do, or a standard collar, which I would normally like to do, Ryan. I'm going to buy a call. Now, doesn't matter. I'm sorry, let me put it this way. You said, think about in the money calls, risk defined long positions, 85 to 90 delta. Just remember the lie of leverage works both ways. What do I mean by that, Ryan? Is if your stock or the market falls 7, 10, 15%, you're still, even with an in the money 90 delta position, going to be looking at 20, 30 to 40% loss in the position. If the stock falls 15 to 20%, now you're probably talking about higher price stocks that are maybe large cap stocks that don't move that much, maybe some Dow stocks you're looking at as well, Ryan, for long term. But in that case, yeah, I'm sorry, the 85 90 delta, just remember that if there is a decline, you're still going to be at that point where you can lose 20, 30, 40, 50% of what you paid into the position. Lie of leverage works both ways. If the stock goes up, you're looking to make one-to-one with the option. I understand that. And get a leveraged return. But as it falls, hey, you only paid $18 for this option instead of $400 for the stock. But if it falls 4 points, you lost 4 points against 18. Okay, so that's only about a 20% loss or so, 22% loss in the position. Now it falls another 4 points. You've lost 8 out of 18. You're almost at a 50% loss in that scenario. Delta's ever changing. It doesn't work exactly like that, Ryan. But let's have some fun. Let's do a quick search here. Might leave some of my other base criteria. Okay, I don't have one here. Let's just clear it all out. Okay, and let's go 180. Let's go to that January timeframe or more. Days at a time. We're going to go deep in the money, 10, but most importantly, let's just go delta greater than 85. And hey, I want some good open interest. I want some good option volume in that scenario. Option volume today. Now I'm going to be doing this, perhaps, Ryan, I mentioned it on higher price stocks. So I'm going to have to allow, I'm not even going to put in a filter for option ask price, but I know I'm not going to let it go above $200. Now, I'm not going to let it go above $100 per contract. Not $100 total, just $100 per contract, not letting it go above that. And I could put in technicals and fundamentals, yeah. But let's go ahead and put a stock price of at least greater than 400. Why not? This is not a recommendation or suggestion, and I'm going to look for mid to large cap stocks. You might want earnings between now and expiration. I'll leave that alone. And yeah, I'm going to want a stock trading above SMA 20, SMA 50. Let's go with 1 day of a positive MACD crossover. And that's it. Some basics. Okay, let's just run that search. Oh, wow. Sorry, end of the day, folks. I apologize. 0.85. Let's do that. All right. Costco seems to be the one, right? Still in an uptrend, and looking at those January options. 330 on 410. What are my deltas here? Didn't add it. All right, that's fine. Sorry about that, folks. So I'm going to go in here. We need that delta in there. That's what we're talking about. And we're going to do something real quick for you here too. Just a second, Ryan. There we go. Okay, good. 0.89, 0.86, both very reasonable. Let's stick with the higher delta for you, the 330. It's going to cost me $8,338 for one contract on Costco, but it's better than paying what? Buying 100 shares at $410.37, right? $41,000 in that case. The potential for good return. If it moves up as we expect, let's increase this a little bit. We know where we are. Now, we're at 410. And in the case of looking at the position, I'm sorry, at 410, I just wanted to illustrate this real quick for you, Ryan. If we lost, I'm not saying Costco's going to, But if Costco lost 15%, that would be a decline of 41, about $60. Okay, we'd lose about $60 here to drop down to 350. Now we have 180 days to go, but let's say it's even a gradual decline. Let's say we drop down to 350 from 410, $60, roughly 15%. And the halfway point is October. So yeah, let's just keep the halfway point, October 20th. And we paid $83.38, and it'd be worth $3,000. So that getting closer to that expiration, halfway between now and expiration, 90 days in, if the stock falls 15%, you're at a huge loss on this position. It's only worth about $3,000. You've lost 5,300 on 8,338. It's a pretty significant percentage loss, more than 50% in that case. Now, if it happens, unfortunately, from a sudden, unexpected event, let's say it happens by the end of August, a month and a half away, still more than a 50% decline. Okay. Now, that's not what I'm saying is going to happen with Costco. I'm just saying that a 15% drop, this is what I was trying to illustrate. You have to be prepared. Leverage works both ways. A 10% drop, even $40 down to 370, might not put us at a 50% loss, again, a month and a half from now. Yeah, so we haven't lost 50% yet, but we're knocking on that door, aren't we? We're pretty close to a 50% loss with a 10%, even with a 0.9 delta. Now, I know that search was as basic could be, and we didn't see a lot of things that we wanted because of the restrictions that we put in. But I'm going to save this search, and we're going to call it Deep ITM, Long Call Far Out. Okay, let's go ahead and save that search. Why do I want to save that search? Well, we know what the market's been doing the last 6 months. I just showed you that. And so let's go to Smart History. It's what I used for Octavio's question to test all the different ones. We're going to go back as far as possible. So I've got 3 months of back testing here. But we're going to go back. There we go, deep in the money, far out in time. I'm going to see if anything matched our criteria, Ryan, May 17th. Hopefully we get a lot of results. I want to see some different things there. Fantastic. Okay. A lot of different options out there. Shopify, Allegheny. I apologize for the delay. I think that was just because we were uploading we're uploading the historical end of day data for today, and that was causing the initial problem. And then the volume and open interest is an issue. Okay, so we've got everything from Align Tech, Allegheny Corp, Markel, Intuit, Adobe, Domino's Pizza, DPZ, NVIDIA. Great. So this is what would have matched on June 1st, about 2 months ago, looking at 234 days out in time. Now, we saw what the market did over the last 3 months and the last 6 months. We were talking to Octavia. We're having that melt up with a little correction, melt up with a little correction, melt up with a little correction, keep bouncing off the new highs and then coming back with those little corrections. So what I want to do now is just calculate the group results. And on this, I'll make the one comment, Ryan, that what we typically look at here in these scenarios is if I'm buying a far out in time call, I'm not necessarily pushing it to a higher delta of 0.85, 0.89, 0.9. What I typically look for is that if I think that there's going to be a growth potential, which we did, both Ernie and I did, we paid into the high implied volatility. I started in April 2nd or 3rd, I think it was, of 2020. After the market at the bottom, Ernie caught it almost right away. It was around March 26th or March 27th. We both started buying January 2021 calls on things like Apple, Microsoft. I was buying Kraft, Costco, Clorox. Ernie was looking at IBM. We bought all those calls, and then as the market started to settle and the implied volatility started to come back down from those highs that it was at the end of March, now we convert them into calendar spreads. We're selling near-term 2-week out or 1 month out calls against them to keep lowering the cost base of that position because eventually the time value is going to catch up with us. So just with those basic criteria that I used there, what are we looking at? Well, you're looking at a 67% success rate after the first 2 months, month and a half from June 1st to today, July 16th. Average 19% return. Biggest one looks like it was Techne Corp and Shopify, 38.3. Oh, nope, there it is. 76% Adobe Systems, 57% for Domino's Pizza. And the biggest loss right now is Lamb Research, and Charter Communications. Okay, so this just gives you a bird's eye view. I know not one historical search does the market make. This is just a very, very brief view. But again, I don't use this general approach myself. I don't go necessarily that high of a delta. And usually when I'm buying a call that's in the money and that far out in time, Ryan, it's because I plan or am starting to trade it as a diagonal calendar spread. I'm selling a near-term call against it for that longer term, mimicking something on a covered call that I can't buy right now. I can't buy a BlackRock at 876.91. I don't know if I'm going to buy this call at 222.65 either, but hey, I might be selling calls against it at the strike price of that time. Domino's at 423, $100 for the 330 call. That's pretty good, but I'd probably start a calendar. Honestly, I think I'd be at 380, 385 and selling 430, 435 calls against it, perhaps near term. Okay, so nothing wrong with that approach. It's a common approach that when investors look to buy long calls, they look for the higher delta. Keep in mind one last thing. You want to take a look at the long option finder. We just saw Domino's at 423. Why am I harping on Domino's? Well, I remember 6, 7, no, it's more than that, 9 years ago, I think, when I traded it as a married put position, and I bought the stock at 13, and I sold the stock when it was at 18. So anytime I see DPZ now at 360, 390, 423, I just shake my head. Why didn't I just hold 50 shares, 60 shares, something like that? Now, Ryan, we're going to go across the entire universe of options. This grabbed every available option. There we go. It's a little better. And calculated which options would give the best return if our stock moved up that 10% in the next month and a half. These aren't the ones we were seeing. These are at the money, aren't they? Out of the money. 460 is probably the deepest in the money option. And let's take a look at that call in the research tool real quick. I want to see what that delta is. That's 63 days out, September 460. Delta's only at 0.68. Okay, why aren't the in the money ones showing up? This did look at every available option, grabbed every price, and calculated what they would be worth theoretically using the Black-Scholes pricing model, and is only showing us the top 10, meaning those deeper in the money, 0.85, 0.95 deltas, wouldn't have as high as a return with just that 10% movement. Let's take it up another $50. Let's put it up to 580, almost a 20% gain from the current price of 482. Now, naturally, we go that high, we're only going to see basically out of the money options because they're so low cost to get in, they're going to have such the highest return. Okay, now let's go 2 weeks out. Yeah, let's go to the 29th. And let's say just a 5% increase up to 500. What's going to be the most profitable in this case? At and slightly in the money, not to the 0.85 delta you're expecting. They're going to be less than a 32% gain. That's good though, you know? Higher delta, 5 or 6% move, you're only going to see a small gain on the position. The more risky at or out of the money ones, of course, are going to have the higher return. Even though you're paying into higher time premium, you do see the higher return. That 490 call just out of the money, 1370, be worth $19.31 if the stock was trading at 500 in the next 14 or 15 days. So your delta approach is good to mimic stock ownership. That's a common approach. Most investors will turn it into a diagonal spread, though, rather than use it in this case. Charles, there's no way I'm going to answer this question, but I really don't have any good ideas for you. Charles says, what is your suggestion for a trader's computer monitor setup? I'm not a trader in the sense that you think I'm a trader. Yes, I'm on the computer all day. I have 2 screens in front of me. That's really all I need. I'm not a day trader, Charles. I'm not making massive adjustments during every trading day. What I'm doing during the trading day is coming up with slides for webinars, as we saw for Octavio. I had 2 coaching sessions this morning, one at 10 and one at 12. Answer regular phone calls and the emails that come in. So I'm not really an active trader. I have 2 screens open. One's always open to PowerOptions, not to trade, but to answer questions that come through on the phone and other comments in that case. The other one is just my email open as well. And when I'm not on a phone call or going and answering an email, looking up numbers in PowerOptions, Charles, I've got PowerPoint in front of me on the right-hand side, or a Word document where I'm writing out an outline for the next webinar, next education, next project, working on the bull put credit spread project, working on the other webinars, Charles. I don't know if I'd use a curve monitor. That's me personally, because I'm not an active day trader. I probably barely make, once I've entered my positions, I've got my married puts, I've got my calendar spreads, I've got my bull puts that I open on Monday for the following 2 weeks out, 11 days out in time. Unless something changes, I don't do any adjustments to those. I let them do what they're supposed to do, taking the calendar spreads to the short-term expiration, have the call expire worthless, roll a put or make an adjustment on the married put positions, roll over a collar. Very rarely do I have to make an adjustment on a bull put unless the market has a big hiccup or one stock just has a big hiccup as well. I've seen competitors of mine. I've seen some of their videos. I watch their videos. Some of them are very educational and I enjoy them. And some of them show their personal screens. And I saw one guy the other day who had a 6-screen tower. He had 3 on the bottom. It was like a pyramid almost. He had 3 on the bottom, 2 in the middle, and 1 on top. No, it was 1 in the middle and 2 on top. It was weird. It's 3, 1, and 2. That's what it was. And I noticed that on 3 of his screens, he had the exact same stock chart with the exact same settings on it. And then 2 other screens, he had something else. Like, what's the point of 6 screens if 3 of them are showing the same thing? I know that's not what he's usually doing, but I couldn't believe it. I was like, how do you even focus on that many things? How many trades are you making per 10 minutes? You need that much data flow going through. Okay, so maybe he's more advanced than me. I'll admit that freely. Maybe he's well more advanced than me. Not a problem. Maybe he does day trading too. Not touching that. Maybe he does futures as well as options and other things. I'm not touching that. So it's all personal preference, Charles. Unless you're going into 3 different securities, what I mean by that is unless you're day trading, trading options and trading futures, I can't imagine needing more than 2 screens. Honestly, if you're just trading options in some stocks, you're not day trading and you're not making more than, even 4 or 5 trades a day, I can't imagine needing any kind of thing bigger than 2 screens. But I'm a little old school because I learned from Ernie. And Chuck says some people just want to look the part. Potentially, and I get that too. If they're showing themselves, it's because they want to come across as the expert and the guru and wow, give you that wow factor, and that's great. That works for a lot of people. I understand that. So, but obviously that's not me. Okay, so Charles, that's the best way that I can state it. I haven't even looked at the curve screens yet. And Chuck adds, I have 1 laptop sitting in my lazy boy. And I know Chuck trades more than I do, but Chuck's also places a lot of it orders after hours because he's down under there. On parts, I think, still stuck in Australia. Is that correct, Chuck? I believe. Haven't been able to go across New Zealand yet, or you're stuck in New Zealand and can't go back to Australia? I forget. Yeah. Oh, you're in New Zealand. Okay. Can't go to Australia now. Can't travel. Ugh. Excellent. Okay, Charles, you're welcome. And Chuck, you said no desire to go to Aussie, huh? And okay, you're welcome there. And Ryan, you're welcome as well. Ladies and gentlemen, we are at 5:50 p.m. Eastern Time. I do think I handled all the live questions that have come in. All right. So I do want to remind everyone, of course, that today's material are my thoughts on your questions designed for educational purposes and increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or direct trading suggestions. I'm not buying a long call next week on Domino's Pizza. I'm not doing a calendar spread zone next week on Domino's Pizza until I run my search and do my research and analysis. Options do involve risk and may not be suitable for all investors. And thankfully, today we got to discuss and see some good hedges that would have worked earlier this year with that initial discussion for Octavio, looking at his bear put debit spread, which worked out well, and just comparing it to other low-cost alternatives that did work out as well. So good couple ideas there. If you like some of the tools you saw today, of course, the search tools, we did a little bit on the history today as well, until it balked on me, but don't worry about that. We'll edit that part out and go right through the discussion for Ryan, so we won't have that lag time showing where we were uploading the new data, the new historical data. But in any case, you can take a 14-day free trial at any time. Just go to powerop.com, put in your name and email address, and you'll have full access to the site for 14 days. After that, subscriptions start at just $45 per month. You can cancel at any time. Trial members and subscribers can have a free coaching session at any time as well. We talked about the free education. At any time, you can just go to our YouTube channel and then find us on YouTube and then just do a search for covered call, hedge, market hedge, portfolio hedge, and just we tag all the videos with the proper terms so you can easily find them there. Or, of course, you can go to our webinars page, powerop.com/webinars.asp, also for more education and information. And if you do think of another question later on this weekend, just send me an email at any time to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. Of course, trial members and subscribers, remember you can schedule a free coaching session at any time.